Hello and good morning. Thanks for attending our webinar on why people buy corporate life insurance. Let's jump right into it. My name is Nick Godfrey, and I'm a business insurance broker, and I specialize in estate and business succession planning. So what we're going to talk about today is why people buy life insurance in their corporations. And what you're going to see in today's webinar are the tax deferral opportunities of corporate-owned life insurance. We're going to talk a little bit about how it fits into one's income and estate planning work. And an important point on this is how it removes a layer of taxation to enhance a person's estate. So what I want to start with is just showing you here that the corporate tax rates have really dropped in the last 17 years. We had a high of 42.4% in the year 2000. You can see the average in Ontario now is 14.4%. In Ontario here, it's 13.5%. So that's pretty good, and it's going even lower next year to 12.5%, as this slide indicates. So you can see 13.5% is paid on the first $500,000. That's what we call the small business deduction. 12.5% on the first 500 starting next year. And then on amounts earned in a corporation in excess of $500,000, they're going to be paying 26.5%. This is providing corporate owners a significant tax deferral within this corporation of, in excess of 40%. Income paid on passive investment income, however, is going to be taxed at over 50%. So you can see that. So if you're getting the small business deduction, you could see that if you $100,000 arrived in a corporation, you're going to pay 13.5%, $13,500, and then the balance is going to be this great tax deferral. So let's talk about getting money out of a corporation. Well, one way is to have the shareholder T Ford. That creates an employer-employee relationship, which is good. The person can then make RSP contributions, contribute to Canada Pension Plan or other pension plans. However, there are some who prefer just to receive dividends, and that provides a lower personal tax rate. And then there's the capital dividend account. The capital dividend account takes the tax-free portion of a capital dividend. For those who aren't certain how that works, is only 50% of a capital gain is taxed. The tax-free portion flows out of the corporation through the capital dividend account, as does life insurance proceeds, less the adjusted cost base on that policy. So there are financial products that are not affected by the passive income rules. You saw that there is a higher level of taxation on those passive investments. And we're seeing that with the new changes, people are actually going to start to lose their small business deduction if they have in excess of $50,000 of passive income. What's nice about corporate-owned life insurance, individual pension plans, and retirement compensation arrangements is that you're not affected by the passive income rules if you hold those investments within your corporation. So taxation. At death, taxes can be triggered at 3 levels. There can be personal taxes that are going to be figured out in your terminal tax return, corporate taxes, and estate taxes, things like probate fees and things like that. So there's some tax planning involved. So income and estate planning. So when we talk to business owners who have corporations, we start to ask the question, do you have sufficient registered and non-registered funds to meet or even exceed your projected needs in retirement? And if the answer is yes to that question, then they might want to consider a whole life policy in their corporation. So why have corporate-owned life insurance, or life insurance at all for that matter? So life insurance is used to fund capital gains taxes, so that, let's say somebody owns a cottage and they've had it in the family a long time, and upon their death and their spouse's death, there's going to be a capital gains tax bill. So where's the money for that? People use life insurance proceeds for that so that they don't have to sell the property to pay the taxes. Equalization of an estate is something that people do. They say, well, I've got 2 kids in the business. One of them's active in the business and the other isn't. I'm going to give one kid the business, so the other kid's going to get some cash. And we do that in the form of life insurance. So that's a good way to do that. And then this idea of removing a layer of corporate taxation, because we use this capital dividend account and life insurance, it reduces taxation as for estate planning. And also, again, just to reiterate, it's not affected by the new passive income rule. So that's kind of useful. Another thing is that there is a lower after-tax cost of premiums when the corporation is paying the premium. So if you need life insurance and it's in the corporation, it's going to be more cost-effective for you generally. So let's say the shareholders die. What's going to happen to the assets within the corporation? Well, they're going to flow out as a taxable dividend, and they pay approximately 45%. So that's what happens. However, if you have taken those corporate assets and sheltered them within a corporation, sheltered them within a participating whole life policy, then it bypasses the tax man, and most of the proceeds, if not all of them, are going to be paid out tax-free to the beneficiaries. So let's talk a little bit about that. We've got Mr. and Mrs. Lawyer. They're 47 and 49. They're earning in excess of their daily needs, so they are taking advantage of this corporate tax deferral and putting money into their corporation. Let's say they took 40% of that $100,000 or $40,000. They took that and they put it into a participating whole life policy. They did with the other $60,000. They did whatever they want to do with it. They made other investments, but for sake of argument, 40% is going into a participating whole life policy, and we've projected already that they're going to have sufficient income in retirement and that they can park this money over there. So if they were to take the $40,000, and I'm just saying that they're going to net 3%, that's 6% pre-tax, which is maybe on the aggressive side. But after 10 years, they would have $512,013. But let's say they both died and it was going to get paid out to their beneficiaries. You'd see they'd net $281,000. However, if they're insurable and we're able to put them in a life insurance policy, we would structure this on a joint and second to die basis. That means the life insurance proceeds only get paid out when the second person dies. Let's say they put $40,000 a year in for 10 years. They would start with an initial face amount of $935,000. Now we let the premium drive that number. So we just put it in the computer and it solves and says, okay, you're going to start with $935,816. We're putting it in a participating whole life policy with paid up additions, and we're going to use the current dividend scale just for sake of argument. So what's that look like in 10 years? So in 10 years, they both die, very sad. And the $935,000 has grown to $1.9 million. Much of that money will flow out tax-free, the $1.5 million. The adjusted cost base of the policy down here is $388,000. They're going to pay some tax on that, so the net proceeds, if you add those two numbers together, you're going to end up with $1.7 million. So that's a nice piece of estate planning. However, if we were to run them out to life expectancy, which we would hope they would end up with, and put them out 40 years, so that $935,000, they put in $40,000 a year for 10 years, that's $400,000. The death benefit is now $3.4 million. And because it's been around for so long, the adjusted cost base is actually zero, and it all flows out tax-free. So that's great for the beneficiaries, but what about them? So the nice thing about a participating whole life policy, it acts very much like a bond. It just continues to grow in value, and the money that's in there grows on a tax-deferred basis. So you can see, if we took them out 20 years, they put in $400,000, there's $820,000 in there. Let's take them out to year 30. There's $1,460,000 in there in year 30. They put in 400. If they need more money because they've run out or they're getting near the end, they have a call on this money and they can take it into their income. Be a taxable event, but at least there's money there for them should they not want to just leave it to their estate. So the strategy on this whole plan is really we want to draw down the registered and non-registered assets first, and we want to let some corporate assets grow tax deferred in a whole life policy. They can access the cash value if needed in later years, and then if they don't need it, the death benefit flows out through the capital dividend account, tax-free, less any adjusted cost base. So that's pretty good. So in summary, why are people going to do this? Because if they're insurable, it's pretty easy. The administration's straightforward. They can pay the premium using corporate dollars, so it's cheaper. And there's a tax-free death benefit, again, less any adjusted cost base. But the longer you live, the lower that adjusted cost base gets, and you can see in that one example it does go to 0. The disadvantage is that there's no protection from corporate creditors. It's corporately owned. You want it to be corporately paid in order it isn't considered a shareholder benefit. And something worth pointing out, the cash surrender value could affect the qualified small business corporate status for the purpose of being able to qualify for that capital gains exemption. That said, that might, be a bad thing in some situations, but for lawyers and lots of people professionals who might have a business that frankly isn't really worth anything, it has maybe goodwill, it's probably not going to affect them. But again, this is something to take into consideration before you do any of these sorts of things, and talk to your tax advisor. So who's the ideal candidate? I would say it's somebody who's got sufficient assets outside the corporation, so we're well balanced in that area. They've got growing corporate assets. The corporate assets are not required for personal income needs for kind of 10 years, because if you're going to put that money into a whole life policy, you really do need that 10 years for it to work its magic, so that you can get sufficient funds in there to really take advantage of the tax deferral and the compounding. It is also great. It avoids the passive investment rules now. That problem removes that layer of taxation. So by bypassing the tax man, it flows out tax-free through the capital dividend account. It's really for somebody who says, yeah, I want a tax deferral. I want this to grow. I might need it, but I also want to maximize my estate. And it also creates a flexible source of tax-sheltered funds. But of course, to be participating in this kind of a thing, the applicant needs to be in good health and insurable. So that's kind of important. So thanks very much for your time today. If you've got any questions, you'll see my contact information is there. You can give me a call, send me an email, visit the website. I would love to answer your questions if you've got any. Thanks very much for your attention today.